Okay, so welcome to Financial Accounting, which is paper one of the CPA course. Today is one of our routine classes where we check in and look at different aspects around financial accounting and how we can prepare ourselves, especially for the exam. So, to those that are joining us for the very first time, financial accounting is paper one of the CPA course. And as somebody who is preparing for exams in the next months, being able to understand this paper in and out is very important for you, either for CPA or any other kind of course. So um, it being paper one, of course, we learn quite a number of different things, and we have a guiding syllabus, and that is the syllabus I'm just trying to share on the screen for us to be able to every time you're studying financial accounting, it's quite important for you to have a guiding tool in regards to what am I studying, how what does the examiner expect of me. So the syllabus will be able to guide you on the different things that examiner expects you to know in regards to financial accounting. So if you've attended some of our previous classes, we've gone through quite a number of things. I've also been able to share videos with some of the students that are part of this paper. So, and I'm trusting that the videos are helpful because these are self-guiding and you can be able to go each of the respective topic at your own convenient. So these classes are just to help us be able to tackle on different areas that you may need to know, especially on your journey to financial accounting, but also to be able to hear from you, respond to questions, and see how we can help each other. These sessions are also to help us look at past paper questions to see how does examiner set different questions, either it's around preparation of financial statements, either it's around depreciation, either it's around bank reconciliation. So we get down deep to each of the respective aspects and see how that plays out even as we prepare for our exams. So as you can see, right now I should have some level of confidence that when it comes to aspects of double entry, it's not something that is now is hard for you, because one of the key things that you need to understand, especially on your journey to accounting, is that everything rotates around double entry. This is your first principle that you need to first understand, the double entry. If you still struggle with this principle, then much likely you will not understand how some of the other things show up. I know that you can try to maneuver through here and there, but the double entry principle is the first thing that you need to be able to understand. And if you've followed some of the classes I've done, one of the things that I continue to recommend is the ALICE acronym, where I say that A is for assets. Your A is for assets. L is for liabilities. I is for income. Then C is for capital. And then this is for expenses. So this, why I usually say it's good for you to use this, is that it is easy to remember. And then you know that when, for example, when each of these elements increase, what do we do? And when they decrease, what do we exactly do? So it's also very important, of course, to know what does an asset mean to you? What are some of the examples of assets? And what exactly are we looking at? Of course, these are all these that I'm listing out here, as they are here, these what we call elements of financial statements. When you look at the different financial statements that we have, you'll get to realize that these items will surface in each of respective financial statements. So that's why we call them elements of financial statements. So when we are looking at the double entry of, let's say, assets, when assets are increasing, and here assets, we are talking about the current assets, but also we're talking about the non-current assets. When these increase, we know very well that we debit them. So the double entry principle says that for every debit, there should be a corresponding credit. So it means that when we are increasing our assets, we debit them. And when these assets are reducing, let's say we are disposing of our assets, we usually credit. And when it comes to liabilities, it's the other way around. When liabilities are increasing, we credit them. Yet when they are reducing, we usually debit. Same thing with incomes. When incomes are increasing, we credit them. When they are reducing, we debit them. Income is like sales income. Income could also be maybe commission received, discounts received. All those are different incomes. Rental income, interest income, all that is income. But of course, the most common income that for all organizations is the sales income, the income that is obtained through the sale of goods and services. So that is quite key to understand. And then we have capital. You know that when capital is increasing, capital is credited. And when it is reducing, it is actually debited. And for expenses, expenses are just like assets. When expenses are increasing, we debit them, just like the way we do for our so-called assets. So when you have, for example, a rental expense increasing, maybe your landlord has invoiced you as a business, then you know you're going to debit your expenses. Of course, since this is double entry, there is a corresponding credit. And if it's an invoice that is coming through from, let's say, your landlord, then you know that you have a debiting your expense, and now you're crediting, say, your accounts payable, just in case you're not paying your landlord immediately. But in case you're paying your landlord immediately, that means that you'll debit your expense and credit your cash, because your cash is the mode of payment, is what you're using to pay the other party. So quite important. And when your expenses reduce, a case in point where you get maybe a credit note for overcharge, maybe from one of your, let's say, suppliers of maybe cleaning or whatever service they are supplying to you. If that reduces, then you know that, okay, for what I need to do with that one is I need to be able to, let's say, credit my expenses account. So that is quite important for you as even as you're on this journey. So this principle is quite important for you. And like I said, even as you advance with your learnings, and even as you look at the different, let's say, financial statements, you need to understand how double entry impacts each of them, and how do we arrive at having a trial balance that later translates into a statement of financial position, a statement of comprehensive income, statement of comprehensive income, the statement of changes in equity, changes in equity, and then you have your statement of cash flows. These are the respective financial statements that we have. Sometimes we also add notes to accounts. Okay, but as per IS1, which is a preparation of financial statements, these are your so-called financial statements. So understanding how all these play in these respective statements is key for you, even as you go through this study. And then, of course, you know very well that before we get to the financial statements, there is what we call a trial balance. And our trial balance picks information from the ledgers. It's the ledgers that are balanced off to give you your so-called trial balance. And where do the ledgers pick information from? They pick information from the books of prime entry, which are your so-called journals, sales journal, purchases journal, and so on. And where do these pick information from? They pick them from the source documents. The source documents are things like invoices, receipts, and so on. So those documents that you deal with on a day-to-day basis, you pick information from there, transfer them to the books of prime entry, then information is transferred to the ledgers, and information is transferred to the trial balance. Now, and then your financial statements. I keep on saying this to my students, that although this is how the principle of accounting is, in the modern era of technology, when you enter the employment world, you may never interface with this, with things like, let's say, books of prime entry, those journals, or even ledgers. For all the time I've been in my employment, I've not worked in an organization where I am actually required to draw those ledgers. What happens is these days we have what we call accounting systems that are in place, and these accounting systems help you to be able to do this within the system. If they give you an invoice and you're entering it in the system, then in one or the other, in the background, you're affecting your books of prime entry, your ledgers will be updated, your trial balance will be updated. When you go to reports and run your statement of financial position, automatically it will be prepared. That is the importance of technology and how it has evolved to affect professions like accounting. But that does not mean that even as we study, we don't study these principles. We study these principles because despite there being some of these technology advancements, they still fall onto the principles of financial accounting. And for you to be able to interpret a financial statement that is run from the system of an accounting system like QuickBooks, you need to have an idea and understanding of how this thing has come up, how were the ledgers updated. Because from there, even when you have an error in the system, then you know what to exactly do. We know how to affect them. I know that systems like QuickBooks also have a ledger, a general ledger option where you enter transactions, not from the modules of, let's say, invoices and so on, but you can enter them through the general ledger where you now doing the actual debiting and crediting, which is really brilliant. So I just wanted to touch base on that and just to also give you quite an introduction in regards to what you need to be able to think about, especially when it comes to your financial accounting journey. So, like I said, we are guided by syllabus, and there are quite a number of topics that you'll find on the syllabus. And I have gone ahead to do a video for each of the respective topics. One of the things that I usually share with my students when they join into this program to ensure that you're not just waiting for this class that we have, but every day you're able to go through some of these videos and they're giving you some level of knowledge that can keep you knowing exactly what you need to do. So, like I said, the financial statements, basically this paper is rotating around seeing how do you prepare financial statements and the steps that also drive us to the journey of preparing our financial statements. So we know very well that if I'm preparing my financial statement, what financial statements am I preparing? I usually tell my students that despite these being listed randomly here, we usually have what we start with. So in most cases, we shall start with the statement of comprehensive income. This is what comes first. And our intention for preparing the statement of comprehensive income is to determine whether the company has made a profit or loss, Now, this is for the private sector. But when we look at things like non-for-profit organizations, this profit or loss may be called excess of income over expenditure, what sometimes other people may refer to as a surplus or deficit. So it's very important for you to be able to be able to distinguish between the two things. Okay, just want to try the word deficit here for you to know. So we usually start with a statement of comprehensive income. Why? Because there's something that we are picking from it that is going to our so-called balance sheet. So this profit and loss goes to our balance sheet, and our balance sheet is usually the second thing that we prepare. So our balance sheet, for it, it's trying to give us basically what's a statement of financial position. And its focus is trying to give us what is our position in terms of assets, what is our position in terms of liabilities, what is our positions in terms of equity, which is capital, what is our position in regards to what? Okay, so the statement of financial position has three areas: the assets, the liabilities, and equity. And we know that from the accounting equation, assets are equal to liabilities plus equity. And the statement of financial position is actually trying to look at how this equation works, your liabilities plus equity, and so on. So the reason why this comes second is because we have a profit and loss that is feeding our assets and liabilities plus equity. Now, what we are picking from here, the profit and loss, is going under the equity items, and it is, when you look at the face of the statement of financial position, you'll see something called retained earnings. So the profit is added onto the retained earnings for the previous period to give you the new accumulated profit or retained earnings. Now, some businesses, especially corporate large entities, because they understand that equity is a broader item, rather than just jumping from the P&L and moving to the statement of financial position, they first do what they call a statement of changes in equity. Okay, so I just wanted to first make it clear that for some businesses, they can move from the comprehensive income and do a statement of financial position. And I've seen this, even the examiner giving you a question and say, prepare a statement of comprehensive income. The next thing, prepare the statement of financial position. Now, for large entities that have a broader components of equity, and go on to prepare your statement of changes in equity as the second item, and then prepare the statement of financial position as the third. Now, when somebody says equity, and I just want to speak about what are some of the components of equity that you can think about. Now, the word equity is basically trying to mean the owner's contribution to the business. And like some of people might call it capital. But for large entities, for large corporate entities, capital is just a component of equity. That is why you have things like share capital as a component of equity. Now, even for large entities, this share capital is actually even broken down, because we usually have what we call ordinary share capital. We usually have what we call ordinary share capital. Now, the ordinary share capital, these are like the ordinary owners of the business. People that have contributed money to the business through the ordinary shares. They are the beneficiaries. They are the last people to be paid off. They are the owners of the business per se. But there is also another category of share capital, which is called preference share capital. And preference share capital, these are owners of the business that have preferential rights over the business. So these that have preferential rights over the business have, of course, have different, for example, they get a dividend even when the business may not make profits. They may also have cases where you have to pay them back their contribution. Preference share capital are also broken down in what we call it's redeemable share capital preference shares. We have redeemable. The word redeemable is double E, double E, redeemable share capital. We also have what is called irredeemable share capital. And the word irredeemable, okay, is double R here. Share capital. Now, redeemable means that the owner of these shares will be paid back after some time. After some time, they will get their principal. Okay. Now, irredeemable, these are more like ordinary shares, but with preferential rights. So when I say more like preferential shares, means that more like ordinary shares means that they're not going to be paid back as per se, but they still have preferential rights. And some of these preferential rights could be to do with them being able to get dividends even when the business is not making a profit. That is what happens with the redeemable shares. Okay. Now, okay. So ordinary shares, preference share capital, and then we have what you might also call the general reserves. Then you might also have your so-called retained earnings. I already mentioned about it. And then you may also have, we can have this for now, okay? So that is how the statement of change and iniquity is prepared in regards to on this journey of financial statements. Now, I want to say that for us, we need to be able to see how do we integrate this into our learning to be able to know how to prepare financial statements, okay? Yeah, so that is what I wanted to share with you. And I would like you to join the next class that is able to help you get into depth of some of the concepts. And I'll just leave a contact that you can be able to check out this.